Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, it's lights out, fade to black for the Screen Actors Guild as actors voted to join writers on the picket lines. First time since 1960 when it was led by Ronald Reagan. Get ready for lots of reruns. This week, both the Consumer Price Index and the Producer Price Indexes were released for June. So how bad is inflation and those pesky prices we pay? We'll tell you. Are we headed towards a recession, or are we going to dodge the bullet? Well, tonight we're going to find out about recession, the economy for the second half of the year, and where are the places to invest with J.P. Morgan's chief global strategist, David Kelly. I'm Andre Laborde. We've got these stories and more. And it's Friday, and it's time for Wall Street Wrap-Up. Hi, and welcome to Wall Street Wrap-Up for this Friday, July the 14th. Well, this week, inflation numbers for June were released, and the Consumer Price Index was up 0.2% for the month and 3% for the year. And speaking of the year, some prices have gone down, food items such as eggs, fish, or milk, but still higher other areas like coffee and cereal. Now, you might be saying, Andre, these prices are not what I'm paying at the grocery. I'm paying lots more than this. Well, you are correct, because that's what they're showing you for the last year. If you measure the last 2 years, prices have soared. I'll give you an example. Ground beef in June of 2019 was $3.81 per pound. Today, it's just over $5 a pound. Now, that's a price increase of 31%. Take another example, as sugar. In June of 2019, the price of sugar was 58 cents a pound. Today, it's just over 91 cents a pound. Now, that's a price increase of almost 57%. Now, for this year, rent has increased over 8%, as well as electricity, and food overall at 5.7%. Now, for the same time in 2021 to 2022, those same areas of rent, electricity, and food increased over 5.5%, 13.7%, and food almost at 10.5%. So, adding over the last 2 years, rent is now up just over 14.5%. Electricity up almost 20%, and food at just over 16.5%. Price increases are slowing, but they're compounding from the previous years, which is why consumers are feeling the problems at the grocery or when you're paying your bills. And according to a recent Associated Press poll of just over 1,700 adults, 30% think the economy is in good shape, while 69% think it's in poor shape. I've always wondered about that missing 1%. Do they just didn't know or have no opinion? Well, how did our money do this week? Well, good CPI and PPI numbers this week showing inflation going down helped the markets to have gains in all the indexes for the week. The Dow Jones was higher today because of the blowout revenue of United Health last quarter. And the top sectors of the week were communication services, discretionary, and tech. Energy and financials were the worst performers of the week. And this week, Dow Jones closed at 34,494, up 2.2% for the week. The S&P closed today at 4502, which was up 2.3% for the week. And the Nasdaq, they closed today 14,100, which was up just over 4.5% for the week. And the Screen Actors Guild and AFTRA, which is the American Federation of Television and Radio Artists, the 150,000 actors voted to go on strike today. They're joining the Writers Guild, which is already currently on strike. And for the first time, that happened since 1960, that both unions voted to strike at the same time. Citibank analysts are predicting that the strike could cost the film and television industry about $150 million per week. And according to Citi, saying that it's manageable as long as it doesn't extend next year into 2024. So, are we headed into a recession, or have we escaped it? Now, according to a recent CNBC Fed survey, about half are thinking we might have dodged the bullet, from 61% who thought we were destined for one in December of last year. That's a great segue because our guest tonight is David Kelly. He is the Chief Global Strategist at JP Morgan. Hi, David. Welcome to Wall Street Wrap-Up.
I'm very glad to be here.
David, we had a great first half of 2023. I mean, the S&P was up almost 16%, and now we're in the back half of the S&P of 2023. Do you think the second half is going to be looking as good as the first?
Probably not. I mean, that's an easy call because it was a very good first half of the year. But we still think the market could move higher. I think the key here is that inflation is coming down. And if inflation continues to come down, then we can see an end to Fed tightening. We can see the promise of lower interest rates in 2024 and beyond. So I think that's really the most important thing to markets. And I think that should help both the bond market and the stock market in the second half of the year.
Well, what about right now? We're into the third quarter. So in the next week, in this next week ahead, and in a few weeks, we'll be having the returns of how the second quarter did. Do you think that they'll be meeting analysts' expectations, or do you think that they'll be surpassing?
Well, they will beat analyst expectations. That's actually one of the weird things is that about 70% of earnings reports beat analyst expectations every time. I mean, that's just how it works, which tells you something about analyst expectations. But generally, I think the story has been very good. It's a tough climate. I mean, there are rising wage costs. I think companies have to deal with a very weird, turbulent economy. And yet corporate profits have been up very strongly in the first quarter of this year. And I think they were up strongly in the second quarter too. So I think companies are doing a very good job of maintaining margins in a very complicated climate.
Do you think the tech sector has been, I mean, the tech sector for the first half of 2023 has been on a roll. Do you think it's been overbought?
Yes, probably it has. I think what's happened is because people expect long-term interest rates to fall, they really think that what's going to happen here is we're going to have a repeat of what we saw in the last decade, which is, when interest rates are low, that helps long duration stocks. The longest duration stocks are growth stocks, tech stocks, where you're not talking about earnings now, you're talking about earnings years and decades into the future. And that's where interest rates are really important. If interest rates are really low, then those far-flung earnings are worth more. And that's really why growth stocks, why tech stocks react so well to the promise of low interest rates. I think that is what's going on here. But we've seen so much money pour into these tech stocks, both because of that and also because of the promise of AI. I think that may have caused certain bubbles to emerge in that area. So as a long-term investor, I'd like to spread it around a little bit more than just tech right now.
Well, David, last week we had the jobs report, and we had unemployment rate that was at a 3.7%. Now it went down to 3.6%. Well, on the theory, that's good. But if the Federal Reserve wants to slow the economy, they would want the unemployment rate to go higher. In fact, in December of last year, they were saying that in the fourth quarter of this year, that they were expecting the unemployment rate to be 4.6%. Now, I will say that they revised that last month in June. They revised it from 4.6 to 4.1. But even 4.1, what happened last week with the jobs numbers, the unemployment rate didn't edge up. They were going back down. Can we avoid a recession with unemployment being so low?
Well, I think we probably can for the moment avoid recession. I don't think a recession is going to start in the second half of this year. But with the unemployment rate, what's going on is we've got this huge excess demand for labor. We've still got almost 10 million job openings in the United States. And the highest number we ever had before the pandemic was 7.2 million. So we've got all these extra job openings. And what that's doing is it means every month there's a lot of hiring. Anybody who wants a job, if you're competent, if you can set an alarm clock, you can basically get a job in this economy. And that's allowing job growth to continue. And at the same time, we've got this squeeze, this demographic squeeze of baby boomers retiring, and that's causing a lack of labor supply. So those two things in combination are keeping the unemployment rate low. And I think the unemployment rate probably will be a lot lower than the Federal Reserve was thinking by the end of this year. I think we'll still be below 4%. But I guess my question is, what's wrong with that? So long as inflation is coming down, a low unemployment rate is a good thing. And I think the Federal Reserve is a little too determined to push the unemployment rate up. I don't see why we have to push the unemployment rate up, because I do think that inflation overall is coming down, even with very low unemployment.
Well, David, if and I'll use the target rate of 2%, and whether we get there whenever we do, when would you see that the way we're going with the trajectory of interest rates and the way the economy is going, when would you see that we may get a 2% inflation rate?
Well, I think we're already a long way towards that target. I mean, remember, back in June of last year, we had a CPI inflation rate of 8.9%. Now we're just a little over 3% on a year-over-year inflation rate. So it's come down a long way. I think because of some of the vagaries of the way the government calculates numbers like shelter costs or transportation services costs, it's going to be slower going from here. So I think the inflation rate at the end of this year will still be about 3% on CPI, but I expect it to go down all the way through next year. As shelter costs come down, as rents stabilize, I think you're going to see inflation come all the way down to 2% by the end of next year. So we're getting there. We're just getting there slowly. And in fact, that's always the way inflation comes down. It's just so long since we've had one of these cycles, we've kind of forgotten that. But inflation always comes down over time, and that's okay. I mean, there's no big deal about 3% inflation. If this were 8% inflation and it was soaring higher, that's a completely different story. But if we're talking about the pace at which inflation goes from 3 to 2, it's not a big deal. It's not worth a recession.
And I would imagine also is that if the consumer is confident about their job, just like what you said, if you want a job out there, you can get, there's help wanted signs everywhere. So if the consumer is confident about keeping their job, that means they'll continuing to purchase. So, and I'm wondering, like with the PPI, the Producer Price Index, which is a lot of more of a gauge that sometimes Federal Reserve looks at, if the PPI is a little bit higher than what they normally would want, and the consumer is still buying, then whether it be a 2% or a 3% inflation, the economy will still be humming along?
Well, I think the economy will be gradually slowing down anyway, because even though, as I said, I think the unemployment rate will be low, we do have a lack of labor supply. And we also have a lot of consumers were living beyond their means over the last few years because of pandemic aid, and then they built up credit card debt last year. And so for a lot of low middle income consumers, it's really hard to pay the rent and pay the mortgage and pay the bills every month. And so I do think there's going to be some drag in consumer spending from that, even with some job growth. So I do think the economy is going to slow down, but that's okay. That's kind of unavoidable. And we also have, we've also got a question of business lending here because of some shakiness in the regional banks. So there are plenty of things slowing the economy down. But there's unfortunately, we think the Federal Reserve will raise rates again at the end of this month. We really don't think they should. We don't think they should play with this, because inflation's coming down. The economy is going to be slow anyway, and I think they're just playing with fire to push rates up much more at this point.
And one of the things you always talked about the Federal Reserve is that they go too far, too long, too fast. And so what you're saying is that probably we're going to be having we're going to have another meeting at the end of this month. And I think we're going to skip August, if I'm not mistaken. We're going to have September. So we've got a few more toward the end of this year. Do you think that, so they'll raise it again for this month, do you think that they will, instead of seeing how things are, with the raising of this time, they're just going to keep continuing if they're on that trajectory of too far, too long, too fast?
Yeah, I think. Well, first of all, they wait too long and then they do too much. I mean, I was just as much annoyed by the fact that they kept these zero interest rates around for so many years before the pandemic, and even after the pandemic, once the economy was bouncing back, they kept rates too low, too long. And what that does is it sets up a lot of problems in the economy. It pushes up real estate prices, it pushes commercial real estate prices. It causes assets to get inflated. And then when you suddenly reverse course and go cold turkey and push rates up to 5% or 5.5%, you cause a lot of problems. And I think that's what the Federal Reserve has been doing here. So they wait too long and then they do too much. That's what they've done. Unfortunately, they don't seem to have learned that lesson. And I do think they will raise rates at the end of this month, even though inflation's coming down. I think they'll probably skip the meeting in September because they will be getting better numbers on inflation. They've got very little excuse to raise rates again. And the question really is, as they think about this, as we go through the next few months, they think about where the economy is. we really are seeing inflation come down, but we could well see a resurgence of regional banking problems in the towards the end of this year, because there are problems on the balance sheets of a lot of regional banks, and there are problems with deposits flowing out. So there are things that could go wrong, and I think at this stage the Federal Reserve really, the balance of risks is they're much more likely to do too much and push the economy into recession than to do too little and let inflation pick up again, because inflation really, I don't think, is going to pick up here.
Well, with the regional bank failures of the couple that we've had, and I'm thinking of Silicon Valley Bank or First Republic or Synchrony and such, do you think that there are more shoes to drop, that they might have more regional banks that possibly invested wrong, maybe invested in short-term treasuries when they didn't go mark to market?
Well, it's possible that we will have some more regional bank problems. I don't want to talk about any individual regional banks, and I wouldn't necessarily say it's because of massive mismanagement. If you think about it, these banks were encouraged to buy treasuries when interest rates were at zero, and some of them may have expanded rather rapidly, and some of them may have made some bad loans. But you've got a lot of different banks out there. The problem is you're putting them under a massive stress test here by saying, okay, now the interest rate isn't zero anymore. Now the interest rate is 5.5% on short-term money. So first of all, can you hold on to your deposits? Is the money going to flow out of your bank and go into money market funds or something? That's one problem. And second of all, let's think about all the assets in your balance sheet which are worth less with higher interest rates. And you've got a lot of little banks, and it's very hard to believe that all of them are perfect here. So I'm afraid the risk of somebody getting into trouble going forward is quite high, and we just hope that we can deal with them in an orderly way, that these smaller banks get folded into bigger banks. We can do some deals as we go along just to prevent a crisis. It's kind of like if you're riding a bicycle quickly, you can keep going. You're riding a bicycle slowly, one little bump knocks you over. And this is a slow-moving bicycle, this U.S. economy right now.
There's a lot of commercial real estate loans that are coming up due at the end of this year and also at the beginning of 2024. And I'm curious, since regional banks do more of the commercial lending than even the larger banks, do you think they'll be more hesitant on keeping these commercial banks, keeping these commercial real estate loans revolving, especially if people are not as coming back to work in the major cities?
There's an old saying that if you owe the bank $1,000, the bank owns you, and if you owe the bank $1 million, you own the bank. So I think one of the problems is one of the problems the banks face is they can't. It's hard to walk away from these loans. A lot of loans will have to be rolled over. A lot of loans will have to be renegotiated. I think you're going to have uncomfortable situations where equity stakeholders in these properties are going to have to come up with more capital. So the question is, which banks have got the worst exposure here and are therefore most vulnerable?
David, you're right. I mean, I've heard that story where when you owe the bank that much money, your banker will call you every day to find out if you don't have any sniffles or if you're feeling well. You were talking about the treasuries. And from what I understand, that we have about $5.2, $5.3 trillion in cash reserves, the consumer. Well, the Federal Reserve had been buying mortgage-backed securities and treasuries, but now they want to sell at least $1 trillion of these securities between now and the end of the year. Well, if they want to sell these securities, by taking this kind of money out of the economy, will that hurt or slow the economy like that slow-moving bicycle you were talking about?
Well, it has been doing it all along. And so I think that's one of the reasons why long-term interest rates have been creeping up a little bit, particularly since we had a settlement of the debt crisis. The debt ceiling crisis meant that for a while the government really wasn't borrowing much money because they didn't have the authority to borrow a lot of money. And as soon as that was settled, the government started borrowing again. And that has put some upward pressure on long-term interest rates. Remember, there are these problems, but there's also a lot of pent-up demand. There's pent-up demand for workers, and there's pent-up demand for vehicles. We're actually seeing light vehicle sales do quite well here because people haven't been able to buy them because there wasn't anything on the lots. And even in the housing market, the mortgage rates are clearly making it very difficult for first-time home buyers, but actually the housing market seems to have stabilized. Housing starts to look like they're improving a bit because there's just so little supply. So this is not a classic setup for a big recession at all. The cyclical sectors of the economy aren't overextended. And that's why I think we can probably get into next year without a recession. But every quarter that goes on with the Federal Reserve raising interest rates some more, with banks running into more and more issues with their balance sheet, with us continuing to run out of workers, every quarter the probability of recession does grow a bit, I'm afraid.
By hoping that we put off the recession by possibly the beginning of next year or into next year, do you think that also then that possibility might be that we may not even have one at all, or a soft landing? I mean, I was watching a recent business show with former Secretary of Treasury Larry Summers, and he was saying that the hope of not having a soft landing is just the hope, and is not talking from experience. So he's very in the camp of we're definitely going to be having one.
It will be good if we can get into next year without a recession, but the problem is that when you're at full employment, you see, when you're not at full employment, when the unemployment rate's like 8% and coming down, you've got extra momentums. You're hiring all these unemployed people. When you're at full employment in this U.S. economy, the average growth rate of the economy is probably going to be less than 2%. And that means you're just one banana skin away from disaster. One bad thing happening, and you're suddenly negative number. And I think that's why. I think Larry Summers is right, because experience suggests, you look at a chart of the unemployment rate going back since the 1940s. When you get the unemployment rate this low, it hardly ever stays this low for long. Sooner or later, something happens, then you're in recession, the unemployment rate zooms up. And that's what happens. So we want to put off the evil day as long as possible, but experience does suggest that we're not going to be able to put it off indefinitely.
With the unemployment rate, the way we have it, the consumer right now is still buying. Do you think producers are keeping prices a little bit higher so that increases their margins so they can make more profit?
No, the way free enterprise works is you're supposed to try and maximize profits, and the whole point is a competitive market means you can't do it forever. I do think that when you look at particularly food prices, actually processed food prices, they do seem surprisingly high. I would have thought that the supply chain issues generally have been fixed, and you would expect those processed food prices to come down a bit. I think they will, because what I think is happening here is a lot of low and middle income consumers who, they had pandemic money, and then after that they racked up credit card debt, used savings last year. Now they're kind of tapped out. And that means that what we're seeing is real food spending is actually falling. And a lot of spending on basics is falling. And I'm hearing this from a number of retailers that, it used to be people were swapping chicken for steak, and now they're swapping peanut butter for chicken. And if you sort of see that going on, then that it's going to be a little hard for those food retailers, food manufacturers, to maintain those margins. So I think you're going to see some downward pressure on food prices in the year ahead.
What about international stocks, David? Do you find that, China has had their CPI was negative, I think, last year. They're having some problems.
Well, yeah, I'd want to have global stocks in a portfolio for a few reasons. First of all, they're a lot cheaper. Right now they're about 30% cheaper than U.S. stocks. So you can buy $1 of future earnings at a 30% discount overseas relative to the United States, and that is a very, very high discount by historical standards. Second of all, the US dollar itself is way too high. Now, it has come down a little bit since last September, but basically that's after going up for 15 years. We've got a big trade deficit. The dollar is too high. Our stuff is too expensive. Everybody else's stuff is cheap. But that means the dollar will tend to come down. And if you invest in foreign securities, if the dollar comes down 10% overnight, and that means international currencies go up 10% overnight, all those international stocks you own will go up too. So we think that a lower dollar, which means higher foreign currencies, and the fact that foreign stocks are so cheap right now is a reason to make sure you've got foreign stocks in a portfolio. I think Europe will do okay. I think the UK is having more of a problem. So the global economy is not booming right now, but I don't think it's headed for recession either. As we go forward, I do think a lower dollar and the bargains you could find overseas are really a reason to make sure you've got international equities in a portfolio.
What would you say is the biggest mistake or mistakes that that the average retail investor makes?
And there are two. One of them is they think they have to find the hot stock or the hot trend. So they go with cryptocurrencies, or they buy into real estate when it's hot. Stop it. If you're a doctor or a lawyer or a business person, you know how to make money. You made money in your own profession. The stock market is simply a way of adding to the returns on that over time. So invest in a very broad, diversified way. Don't go for home runs. Try to hit singles. And the second thing is keep your emotions out of it. People want to get out of the market when they feel gloomy, and they want to get into the market when they feel great. The problem is that when the stock market's down, they feel gloomy. And when the stock market's up, they feel great. So what happens is if you invest emotionally, you're just committing yourself to, I'm going to buy high and I'm going to sell low. And that really is the exact reason why the average individual investor doesn't tend to do as well as they should. So don't think emotionally. Just look at rationing at prices. Try to be diversified. Don't look for the hot thing. Just recognize that the global economy will reward broad, diversified investors over time.
David, I could talk to you much more. I hope you come back.
I'd love to do that.
Hey, thank you, David. Well, hey, if you've got a question or maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us. Notice also the new email address at andre@benacapital.com. So let's take a look at the markets heading into next week. But first, on this day, July the 14th in 1862, Congress established the very first U.S. pension. But what was it for? We've got the answer coming up. Well, on this day, July the 14th in 1862, Congress established the very first U.S. pension. What was it for? For injured or disabled Union soldiers of the Civil War. And the pension paid up to $8 per month. Well, that's a wrap-up. Let's have a wrap-up on Wall Street Wrap-Up. Well, the new Gallup poll shows Americans are losing their faith in higher ed as the end-all to the American dream, with the cost of college and getting your money's worth. Now, 62% of Americans, 2 out of 3, now either only have some or little faith and confidence of the college system. Well, for the first time on record, Switzerland will be importing more cheese than it exports. The country's Dairy Association says cheese prices aren't covering the cost of milk right now, which is needed for making the cheese. Looking for a job with good pay? Well, the average AI, artificial intelligence job is now paying $147,000 a year. Now, of course, the trick to AI jobs is hanging on to it because they'll take over your job. And finally, this Saturday's Powerball jackpot is now over $875 million. Probably it's going to go higher by the end of this show. It's the third highest ever, and the odds of winning is 1 in 292 million. So 1 in 292 million, so you're saying there is still a chance, right? Well, not good odds. Stick with the stocks. And that's a wrap-up on Wall Street Wrap-Up. Join me next week when we'll be talking with the editor-at-large for Barron's, Andy Serwer. And we'll be talking about AI and where he thinks the economy is headed, much more. Andy Serwer will be with us next week. And that's our show for Friday, July 14th. Our thanks to J.P. Morgan's David Kelly for being with us this evening. But as always, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and always remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.